Yeah, we're actually live now. It is
Oh,
streaming
sweet.
directly into the group, and then so it's going to the Real Estate Moneymakers group and also the YouTube. So we are live, everyone. I'm assuming we're live. I'm not checking it because last time I spent minutes checking it, and I was just wandering around on screen uselessly here. I am also on TikTok live, but if you are on TikTok, I am streaming this on my YouTube. I am with Keith. Keith is with Valor Insurance. I want him to give his background to explain how he can help you as a real estate investor and his experience working with real estate investors. And we're going to dive into what the heck is going on in P&C Insurance right now. So, Keith, introduce yourself and tell us about yourself.
Yeah, absolutely. So I've been in the insurance industry since 2010. So 14 years this month. And initially when I started, I was just working remotely for another independent agency, actually based out of Chicago. I was working remotely for them down here. A couple years in, got a chance to help a wealth management firm start an insurance agency. That was in 2013. And just a local wealth management firm that wanted to start a scratch agency. So it was a great experience. Got to learn basically on someone else's dime how to start an insurance agency. And after doing that for them for about, I guess I was with them 14, 15 months running it, kind of decided, if I can do this for somebody else, I can do this for myself. So July 2014 started what is now Valor Insurance. Initially, we were branded as the American Insurance Group. That created a lot of kind of confusion over the years in the market, just with AIG being that huge brand. We'd get calls kind of regularly, people thinking we were AIG, um, and we weren't around in the 70s when some of these original policies people were calling about, um, or they had questions about. So we rebranded last year. So it's Valor Insurance. We kind of a general property and casualty agency, a little bit of life insurance, but our niche is in the real estate investor space. That's probably, maybe 30-40% of our total book of business is in that real estate sector. Kind of broad in that investor segment. So anything from a couple single family homes to large single family schedules, apartment complexes, self storage facilities, commercial properties, about anything you can own in the investor space. We insure. Kind of the only area that we'd probably refer somebody out would be people that just had a bunch of um, just pieces of land where they're putting trailers on it, trailer parks. That's just not our jam. It's kind of a
Yeah.
unique space. Not a lot of carriers like that, and so the ones that we've partnered with, um, it doesn't fit what we're looking for. So about anything else we can handle. Uh, but you did touch on the insurance marketplace at the moment. It it's a mess for sure. And
Yeah.
so,
So I've been having investors, they'll come to me and they'll say, my insurance premiums are going up, but I have no claims. I need to shop around and switch companies.
yeah,
So if we can backtrack it, because you've been in the insurance industry much longer than I have, what is the root cause? What started this snowball that's going on right now?
yeah. The short answer is, as a government, we dumped a lot of money into the market. Is part of it, and then also natural disaster being another massive part of it. The insurance industry in general goes through some hard and soft market cycles. So a soft market is a cycle that we came out of, where carriers get very aggressive on writing a lot of new business. The pricing gets very competitive. And so we were in that for a long time. It did follow interest rates a lot. So as those came down, carriers were very competitive in trying to pick up new business. Um, two main areas of the country that really hurt us: Florida and California, with some of the wildfires in California, and then of course some of the big hurricanes. And now you might be thinking to yourself, well, I'm not in Florida, I'm not in California, I'm in Tennessee, I'm in the Midwest, I'm in a different part of the country. What we have to remember is, insurance is part of the pool, and even regional carriers, a lot of times they're kind of tied in with the overall market because uh, reinsurance, right? So one of the things that happened is a lot of the carriers after uh, the big fires and the big hurricanes, their reinsurance treaties changed. So a reinsurance carrier is basically an insurance company for an insurance company. And so as some of those changes happened, that then trickled down to all of us, right? So the two sectors in particular that got hit really heavy, auto insurance and property insurance. Those are the two that got hit really hard. If you were in construction and you had spent a lot on workers' comp, you're loving the rates because they've come down for probably 8-9 years in a row and are coming down again this year. That's casualty though. Property in particular is through the roof, and we're seeing, again, the inflation piece, the cost of claims has skyrocketed. I was looking at some statistics the other day, and in some cases have doubled or tripled the cost of paying, on an auto claim to repair a vehicle. Now they're totaling a car because it used to take maybe $3,000, $4,000 to repair that vehicle. Now it's $10,000 to $11,000 to repair that vehicle. So now we'll just call it a total loss. On the property side, I mean, you guys see it if you flip houses, the cost to rebuild, to repair a house, it's way more expensive today than it was a year ago, 2 years ago, 3 years ago. And that's all just trickled down to the cost of the insurance. And
So
so
it sounds like the reinsurers who insure the insurance companies, it started with them basically. They sort of set the top and it comes down the layers.
yeah, that's part of it for sure. That's a big part of it. They're the
Mhm.
ones that got hit with the really heavy claims, and so they've tightened up what they're willing to insure. And so there's the two aspects that are hitting us now. It's the cost of the insurance, and
Gotcha.
then what they're willing to insure. So the what they're willing to insure, that typically follows the reinsurers, because sometimes based on that particular insurance company's treaty, they just say, hey, you can't insure this type of risk. So if you're big in apartment complexes, you'll see now that some carriers will not touch an apartment complex if it's more than 30 years old.
Right.
And the reason being is because typically the insurance company, the primary one, it may be insured for, let's say, 5, 10 million, 15 million. The main carrier is insuring it for maybe half of that, and they're buying reinsurance for the excess. Well, that reinsurer doesn't want it anymore, and so now the primary carrier doesn't want it anymore either. And so it does vary a little bit by carrier, but there are certain sectors that are getting hit worse than others. And I would say the apartment space, older apartments that are frame construction are very tough to insure right now. And so some carriers have hopped off completely. Nationwide, for example, if you
Mhm.
have an apartment complex and you have not gotten your renewal yet from Nationwide this year, don't expect to, because they are non-renewing their entire book of business, and you will probably pay double to triple or more what you were paying before.
Now, how much notice would an investor get that their policy is not being renewed, and how much time would they have to correct that?
Yeah, typically when a carrier non-renews the entire book of business, they get it pretty far in advance. It'll vary a little bit by state with how much notice. I think for commercial, it's 30 days in Tennessee. I think maybe 60. It varies a little bit by state and by line of coverage, but generally you're going to see it at least 60 days out. And then if you're working with an independent agent, a broker, your broker is going to know generally way before you do. And they should hopefully be able to get you taken care of well in advance of that non-renewal notice. Just know if you're trying to buy something, I think this is where you gotta be careful when you're buying a new property, right? If you buy new property and you see that person's financials or P&L, and it says whatever $8,000 for insurance, you definitely want to know who the current carrier is, and will that carrier insure the property moving forward. We had one where one of our existing clients was selling an apartment complex. It was a 16-unit single location. I think it was 9,000 or so in premium, and Guard was the particular carrier. They're a Berkshire Hathaway company, big, but they've really tightened up on apartment complexes, and their restriction was 30 years or more. And the guy that was buying the property, he couldn't replace that exact same policy with Guard. Guard wouldn't take it anymore. And the next best price he could get was $16,000 for that exact same property. It almost doubled the cost of the insurance just because he bought it. Guard would have stayed on it for the existing client for probably another year or two or more, we had already renewed it, but they weren't taking any new business if it's more than 30 years old.
Gotcha. So let me ask you this. If you're an investor and your premiums went up, is it wise to shop and switch to a new carrier, or is it better to stick with the carrier that you've been with and you have a history with?
Yeah, it's not necessarily going to hurt you if you move your insurance to another carrier. I'll give you a couple tips, and some of it will depend on the individual investor and the size of their portfolio, because there's different things you can do to decrease your cost of insurance depending on if you're really a commercial risk or you kind of a first-time investor or a smaller investor that can still insure it personally. If you still have your insurance that's really a personal lines account. So let's say you have less than 10 single family rentals, maybe quads, duplexes, triplexes, things like that. A lot of that cost is tied to your credit score. And so if you have really good credit, it probably makes sense to stay on commercial paper. If you have terrible credit, which sometimes you do when you're a smaller investor because you've leveraged a lot, go keep maybe stay the same carrier, but put it on commercial paper because that's not tied to your credit. And a lot of times people don't realize that. So just by switching from a personal lines carrier, if you're a smaller investor, to a commercial carrier, your cost of insurance can go down. And usually then you're going from 5, 6, 7, 8, 10 policies to one single policy for your whole portfolio. And then the other piece that a lot of people don't realize too is on the commercial side, that pricing can be flexible because they're looking at the entire risk for the account and not so much your credit. Personal lines insurance, the cost just is what it is. You put it in the system, there's no discussion back with the underwriter. Hey, this is a good risk. I think we need to knock 10% off. That doesn't happen on the personal line side. So if you're a larger investor and you're still on a personal lines policy, go to a commercial. You'll probably get better coverage, a single bill instead of one bill for every single house you have. I mean, there's some investors who picked up, have 35 different properties, 35 separate policies. That's a personal lines account. Go to a commercial account. Coverage will be better. Pricing will be better. Billing will be better. Everything across the board will be better.
Nice. So what about roofs? Because that seems to be under more scrutiny now that if your roof is over 20 years old, it seems to get more difficult as far as getting coverage and stuff. But what would you advise as far as if investors looking at a house and insurance companies are tightening up on their standards? What's some key points that investors should look for on properties to determine if it would qualify for insurance or have trouble with insurance?
Yeah, great question. So general rule of thumb is 15 years or more. Then there's carriers that start to drop off as far as either eligibility or the cost of the insurance. 20 years is another time limit above that, then your options are limited. You can go to some standard carriers that will still do an older roof, but they may just put a actual cash value endorsement on there. So basically meaning they're not going to pay you a whole lot. They pay you what it's worth at the time of the loss, not what it costs to replace it, right? So 30-year-old roof, 20 grand to replace it. Here's $3,000 because that's what it's worth at the time of the loss, right? That's an actual cash value policy. So sometimes you have to go to that unless you're willing to replace your roof. Some
What if
carriers,
somebody says, "Oh, well, my shingle's a 40-year shingle"? Like, does that make any difference if you provide proof of that, or?
no. If you had a metal roof that has that longevity, some carriers are willing to do that. But if it's shingle, not going to matter.
Gotcha. So these roofing companies are selling these 30, 40, 50-year roofing shingles. Insurance-wise, they're just like, nope, doesn't matter.
Nope, exactly. Yep.
Okay.
We have some, especially on the personal line side, that, I mean, if it's more than 15, you're just straight up not eligible at all. It's not like they'll even give you the option to do that actual cash value endorsement. You're just not eligible.
Yeah.
Yeah,
It
so
seems
the
like,
roofing,
and that seems like one of the areas that insurance companies have been litigated on is the roofs. You see all these roofers out there saying, we'll
yep.
get your insurance claim. And this seems to be an effect of that now.
Oh, 100%. Yeah. If for some of the storms that we've had come through over the last decade or so, if a hailstorm comes through, expect all these roofers from out of town to come door knock, and their pitch is, hey, I can get you a free roof. And yeah, you sort of get your free roof, get the insurance to pay for it, and minus your deductible. Uh, and so, yeah, we're seeing the effects of that for sure. And that's one of the ramifications of Florida. Um, Florida has more homeowner claims. Uh, excuse me, let me clarify that. Florida has more homeowner lawsuits against insurance companies than any other state. Something like 90% of all lawsuits against homeowner policies come from the state of Florida. And it had to do with the ability for attorneys to get litigation fees that were absurd. They'd sue for a $20,000 settlement, and the attorney fees would be $150,000. And so you have Florida to thank for the roof problems that we have now in Tennessee.
So, what's the other key areas that investors should look for? I know I had one of my owners. She got a notice that she had to pressure wash her house, for insurance to be renewed. So it's kind of funny, some of the small things. The other thing too
Yep.
is some of the companies are using like aerial imagery
Mm-hmm.
to look at properties, and that seems to be create some conflict as well. But what's the other key
Yep.
areas investors should look at?
Yeah, absolutely. So a part of it is when it comes to insurance, we now have to really sell the client to the insurance company almost as much as we got to try to sell to the client to try to pick them up. And so we try to make our clients look as good as we can from a risk perspective. And as funny as it sounds, cleaning the mold, whatever, off the side of the fungus, whatever that is growing on the side of the house, that's not necessarily going to cause an issue, a water leak, but it looks like a poorly maintained house. And to the carrier, that's a red flag. And so there's all these little things now that are a slight red flag that they're looking for a reason to not insure you. Whereas 2 to 3 years ago, they were looking for any reason to pick you up as a client. They wanted to write business. Now it's the opposite. And so the more that the investor can do to say, ooh, no, I'm a good risk. And so some of that is making sure your property, all the minor stuff is maintained. More and more companies are doing those property inspections either before the policy is issued, or in a lot of cases within a couple of weeks of the policy being issued. And so we've run into that where investor tells, oh yeah, no, it's our properties are amazing, and we get some of these inspection reports back, and it's like, have you even been to your property? Because the place looks like a dump. And so then they get canceled or non-renewed, and then it's tougher to get coverage because you've been non-renewed. So roof age and just general property maintenance is a huge factor for sure.
Is there a checklist these inspectors look at, or is it all just vary from inspector and company?
It'll vary a little bit by carrier and what specific things they're looking for, because most of the insurance companies have outsourced the property inspections to a third party, but they've got a specific list that they're going through. So, here in Chattanooga, we got a lot of elevation changes. So front steps, if you've got more than 2 or 3 steps and you don't have a railing, oh yeah, we're out. You better have a railing on that front little stoop on that patio. Um, so that apartment complex that I was talking about earlier that my client sold, when they first picked up that property a couple of years ago, after inspection, there's a couple steps that didn't have an appropriate height from a railing perspective. So the carrier said, hey, if we're going to stay on this, you better fix that railing. If that was today and that inspection happened, they just would have canceled the policy due to the
Gotcha.
risk. So some of those little things that have changed. Don't give them a reason after inspection to hop off, because now they're less forgiving post inspection than they were.
Gotcha. So how much do you see, have you been seeing premiums increase on people? And is there a particular property type or segment that is going up higher than others, or what are you seeing on that?
Yeah, vacation rentals has been one that's been hit pretty hard. Apartment complexes as well. Single family rentals, some, but if you're on a decent size schedule, you have 10 plus single family to quad schedule, you're not getting hit as hard as the other stuff. But it's the vacation rentals that a lot of carriers have really pulled back on. And so we're seeing a tightening of the eligibility, and then in some cases the pricing double at renewal, or triple in some cases. So if you have if you're heavy in vacation rentals, just expect your pricing to go up a lot. And especially if you're in the Gatlinburg market,
Mhm.
a lot of carriers have, not that they've opted to non-renew that area, they've just decided, hey, we're not going to take any new risk in that area. And so if you're already there and you're covered, well, you may want to shop, you just may not have as many options should your carrier take a major increase. So two particular companies that really were in that space pretty heavy. Foremost, which is part of Farmers, they were in that
Mhm.
space pretty heavy, and then Openly, they were a newer to market player, and when they hit, they were very competitive, and their coverage is phenomenal. Uh, they totally closed off Gatlinburg, and so you're not even eligible anymore. And then if you're insured with Openly, they announced back in the fall uh, that as an entire portfolio, they're renewing at a minimum of 57%. I think was their, or excuse me, not minimum, average rate increase on their entire portfolio is 57%. So we've seen some that are, of course, less than that, but we've seen quite a few that are higher than that. So if you're insured with Openly, know that you got a great policy, and it's probably cheaper this year than it should be, but just expect your renewal to maybe double.
Yeah, and one of the main points I want to get across is that just because you haven't had any claims or any issues, uh, that doesn't mean your premium won't go up. Like some
Yep,
people take it personally as
totally.
that I've not done anything wrong. Why is this company I've been with raising the price?
Yep.
And uh, I think that's something to be aware of. That industry, it's not being well publicized. It's just in a lot of chaos right now,
Yeah.
and those rates are going up. How long do you see that going on for? Like,
Yeah, that's a great question. Like I mentioned, it goes through cycles a little bit. Fortunately, Tennessee is more favorable from a regulation standpoint than other states, and so the one nice thing is Tennessee can make adjustments quicker. The carriers that are here in Tennessee can make rate adjustments quicker than some other states. Some states like California, I believe it's a minimum of a year, it might even be 2 years from the day they submit for a rate increase before it can
mm,
actually go effective. So in California, you're seeing carriers just saying, hey, we're not going to write a risk because they can't take the rate increase fast enough. Here in Tennessee, you'll see a rate increase faster, but you're not going to see a tightening as much from a restriction of coverage as you are in, let's say, California or Florida. So I think if you've already renewed in the last 6 months, 6 to 10 months, you probably have weathered the worst of it. If you're up for renewal sometime in the next 2 to 3 months, that'll be the first kind of big shock. So I think we've gone through most of it already, but this year will still be overall kind of generally still a tougher year from a renewal perspective. Um, Hopefully 25 will be better. But fortunately, Tennessee can adjust faster than some of the other states.
okay, yeah, that's actually a Facebook question that popped up. Any forecast on when things may swing back towards normal? So you're thinking 25, 26?
Yeah, probably 25. I mean, one of the things to look at as some of the industry publications put out some data on each quarter of the key metric in the insurance space for the carrier is what's called the combined ratio, right? Basically, it's basically a number of their profitability. And the more that's above a one, the worse that is, right? Anything above a one means they're not profitable. And the combined ratio for certain segments have been 110%, 120%, and that's starting to drop back down to where it needs to, so that the carrier can actually be profitable, right? Because they're a business too, right? So they need to be profitable, make money, um, and so that's starting to normalize again. Uh, Again, a little bit by state. And Tennessee's better than others. Um, just know that if you're coastal or in what's generally a blue state, unfortunately, the more regulated states, those are going to take longer to recover, and it's going to be harder to do business in. Um, uh, Tennessee's just a better business state, fortunately.
Now, I know that's the investment side. Homeowner side seems to be worse. Seems to be a lot fewer choices as far as carriers go versus the investment side. Is it basically in the same boat as
Yeah,
far
it's
as
it's
time
basically the
frame?
same boat, partly because It's kind of not the same product, but it's a very similar product. It's a combination of people are living in some sort of building. So the main driver is the property piece, whether it's um, a tenant living in there or it's your primary home. Now, I think there's still more options on a homeowner policy than, let's say, apartment complex or some of
Well,
the
yeah,
bigger,
yeah,
the bigger
absolutely.
ones.
Yeah.
But yeah, in some cases, and I think some of it depends on where you're at. If you're
Yeah.
in some of the higher risk classifications, like if you live out kind of where I am, I'm on the back of Signal Mountain, and fire classification is a big deal. And so my fire department that handles where I live is a volunteer fire department.
Mm.
So I'm not in a what's called fire classification 9, PC 9. I'm in I think ours is a 6. So that's still pretty good. But if you're in a 9 or a 10, where the fire department is usually not within 5 miles, where you live off the road quite a bit, that could be a lot harder to get coverage than it used to be. So,
Gotcha.
and we do have some of that in the Tennessee area for sure.
Uh, how big of a difference does a crime score make as well?
Ooh, yeah. So that one already made a big difference in downtown Chattanooga before all this mess. I mean, there are certain parts of downtown where, especially if you're buying an apartment, where the crime score, you just weren't even eligible. They just wouldn't even offer, and so that's even more of a factor now. So that's a great question. Most people don't think about that, um,
Hmm.
but there are certain parts of town that carriers just they will not offer coverage if it's a commercial policy. So that's one where if it's part of your overall portfolio and you're on commercial, you may be eligible in personal lines because they're not looking at crime score near as much. But on the commercial side, yeah, they pay very close attention to crime score.
Gotcha. Um, so just kind of switching, we cover the market, switching just sort of basic insurance for investors knowledge. What's the most common misconception that you see investors have when it comes to insurance on their properties?
Yeah, I see. Often they want to insure it for what they paid for it, and most investors they're buying deals, right? So let's
Hmm.
buy this thing. You buy it for $50,000, so I should insure it for $50,000. Well, insurance is designed, if there's a total loss, to give you what it costs to rebuild it, not necessarily what you uh, paid for it. And they don't necessarily have a cash out option all the time. So, okay, if you only insured it for 50K and you have a total loss, that doesn't mean you're getting $50,000. You'll have co-insurance penalties, and so you may only walk away with $30,000. And so it's really understanding the contract and what you want to have happen should something go wrong. That's really the key, right? What are we doing with insurance? We're transferring the risk to another party. And so uh, we deal with lots of different investors, some that are willing to self insure more, keep their costs down. But it's mainly just knowing when something bad happens, how will this policy respond? And too many investors don't care. They just want a cheap policy. And then when something bad happens, they really care. But it's
Yep.
too late it's too late at that point. And so
Yeah.
I think there's just not enough time spending the 20 minutes, 30 minutes that it takes to truly understand that policy on the front end so that when the bad thing happens, you didn't just lose what you've worked the last 10, 20 years of your life building. Um, and so that's the biggest thing that I think people miss out on is just really understanding their insurance.
Let me give you a scenario that happened to my owner recently. Um, they have the house, they have like a little single detached garage.
Mm-hmm.
A limb fell on the detached garage. Her roof on that garage was old to begin with. And
Mm-hmm.
she said, well, can I submit a claim on my insurance? So like I told her you could, but is it wise to really like submit claims on small stuff with the current state of the industry it's in?
Yeah, I would say, especially now more than ever, self-insure on the small stuff as much as possible. I mean, if you just financially have no option, file the claim. Uh, just know that you're going to face future ramifications because you did. Um, so, yeah, I highly recommend. Kind of my general rule of thumb for both an individual or a business owner. If it doesn't affect your financial situation for the year, like if it only hurts the budget for the day, for the week, or maybe even the month, consider paying that out of pocket. If it ruins you financially for the year, okay, file the claim. And everyone's financial situation is a little bit different. Some people are newer investors; they don't have a whole lot of cash reserves, so a $5,000 claim really hurts them, and they maybe don't even have 5,000 cash to self-insure on that. But a seasoned investor that has a portfolio of 10, 20, 30, 40 properties, put your deductible at $10,000. Keep a set of cash reserves for a bad claim, and unless you have a $20,000 claim, don't file it right now, because you'll end up paying more on the back end when your rates come back. So that's where, yeah, you kind of want it based on your own personal situation, but self-insure as much as you can. It does two things for you in the long. Well, the main thing it does for you in the long run, it keeps your cost of insurance more lower, and you end up saving more in the long run by doing that.
So if you have a portfolio of 20 properties and if it's all on one commercial property, if you have an issue on one property, it affects the entire policy, right? Like they're all combined together.
Yes and no.
Okay.
It will, but there's still a spread of risk, right? So
Okay.
you have carriers look at frequency and severity. So they're going to look at frequency for sure, but one single severe thing on a portfolio is not going to hurt you as much as 5 $2,000 claims.
Gotcha.
Because they know, hey, you got a frequency issue, you're going to file everything you can,
right?
And they don't want that.
So what about if an investor is looking to buy a property, and the property itself had a claim of some sort a year or two or whatever ago? Does that affect their ability to get insurance on that property?
I mean, as long as the issue's been remediated now, especially if it's a weather-related item. I mean, if you have an ongoing problem, like if you're in the flood zone and that place has been hit multiple times, yeah, which flood is a unique item in and of itself, that is going to be a question mark. But when it comes to, that limb example, right, that had nothing to do with the prior. That had nothing to do with the new owner.
Yeah.
Only followed the prior one. So, yeah, not really an issue on that front.
So what's the most common coverages you think investors should get, but they don't add on to their policies?
Oh, easy. An umbrella policy, especially the bigger investors. We've worked with some that have, I mean, they've got a portfolio of real estate that's worth $10, $15 million, $20 million. And the most amount of liability coverage they have is what's on the base policy, which is either $500,000 or $1 million. And it takes one slip and fall, one major accident, and then your whole portfolio is gone. The casualty space, the liability side, that's some of the cheapest coverage you can buy. So get a $5 million umbrella, get a $10 million umbrella. The liability costs for real estate is really low. And so make sure you're set up on that side, because it's just cheap insurance.
What's the most common liability claims? Is it falls?
Dogs.
Dogs. Yeah, dog
Yep.
bites. Yep.
Dog bites, and the average cost of a dog bite average is over $50,000 is the average. And so from a risk mitigation perspective, don't let your tenants have dogs, and make sure your tenants have a renters policy, because if one of your tenants' dogs bite somebody, their policy needs to cover it, not your policy. Your policy should be the backup.
Gotcha. What happens? So a lot of investors, it seems like they just want the insurance policy and then that's it. But they don't actually know what's in the policy. For example, the dog bite thing. If they have a tenant, they have a dog, and then that's not in the policy, they're just kind of out there, I guess. So how do investors learn about insurance in an easy and simple way, I guess, so they know what they've got? Because that seems to be a disconnect between what investors have on insurance and kind of what they think it covers sometimes.
Yeah, absolutely disconnect. And I think it's not understanding kind of the value and the why behind it. Most of the time I hear, oh, I hate insurance. I hate insurance.
Yeah.
And
Don't
generally,
trust insurance companies.
oh, 100%.
Yeah.
And a lot of times they haven't gone through a significant claim and seen the value, if they did go through a claim, it was one that wasn't set up correctly. We've had some pretty large claims for some of our real estate investors. We had one, the guy owned an apartment complex, and tenant left the stove on and caused a grease fire, and it was like $650,000 claim, and it cost him his $5,000 deductible, and he got almost a brand new building. He's not complained about his insurance and did not complain about it not being set up correctly because he was well taken care of. And so it's just a matter of doing that on the front end, and especially when it comes to all the types of insurance that's out there. Real estate investor coverage is pretty straightforward. It's like a homeowner's policy, usually just with bigger numbers or more locations. Right, you're generally not going to have contents coverage because you don't own the stuff on the inside, but everything else is kind of the same. So just taking that extra 5-10 minutes to understand, okay, here's what I'm buying, and just asking your broker number of questions of, even if it's the scenarios that we just talked about. Hey, if this happens, what's covered? If this happens, what's the deal here? And then understanding, okay, am I getting a basic policy, or am I getting a Cadillac policy, or do I want something in between? Because there's lots of options. And again, it's understanding what options are available and which ones make sense for me. Right. So in Chattanooga, for example, we have a lot of older houses. We had a lot of new ones coming online that people are building and whatnot. But a key coverage that I see a lot of investors miss is the ordinance and law coverage. Right. So they buy an older property, especially if it's multifamily. You have way more codes today that are in play than when that thing was built 40 years ago, 50 years ago. We dealt one, I'll give you an example. We had a triplex that we were insuring. The stairs in the triplex, it didn't have a landing before it turned. It just came down and turned. Well, after the fire that damaged 2.5 of the units, code made them rebuild all the stairs. And if they didn't have that correct coverage, the ordinance and law, they would have had to come out of pocket for the extra cost to rebuild that staircase with the correct landing. The separation from a fire perspective, I believe it was just 2x4s with a single sheet of drywall is what code could do, allow you to do back in the day. Now it's offset 2x6 with, I want to say it was 2 5x8 sheets of drywall in between the units. That's a bigger cost from a rebuild. So if you don't have that coverage, insurance is not going to pay for that difference in cost. So it's just those little tweaks like that that make that is going to help you should something bad go wrong. Because at the end of the day, you're buying a piece of paper that you hope you never have to use, but if you do have to use it, you want it to be right. You don't care anymore how much it costs when you have to use it. You care if it's right.
Yeah, water backup coverage is
That's a
good
big
too.
one.
That's one that people don't think about.
Yep.
And I've had it happen on properties we've managed before.
Water claims can be some of the most frustrating because there's so much nuance in the claim depending on what the cause is. The easy one is the pipe burst.
Yeah.
We're good. The other one is there's water in my property. Okay, where did it come from? Why is it in your property? Is it just seeping up from the ground? Is it what's causing it?
Yeah. Let's see. I had another question I had for you. So a couple of terms, if you could explain them simply for people that I think most people don't get, would be co-insurance and then replacement cost value versus actual cash value. Like what's the differences in those? Because people they just see these words and don't really know what they mean.
It doesn't mean anything. Yeah, exactly. So co-insurance, that's a key one to understand, especially in the investor space, because as we mentioned earlier, a lot of investors want to insure the property for what they paid for it, not for what it costs to rebuild it. And the insurance company wants you to what's called insure it to value. So insure it to the value that costs to rebuild it. And if you don't, then you get hit with that co-insurance penalty. So in our scenario, just let's use numbers, easy numbers. I'm not great at math, so I like easy numbers. $100,000 property to rebuild it, if I insure it for $50K, right? That's 50%. And so in a claim, I did not insure it to value. So my co-insurance penalty is 50%, right? So if a claim happens, the insurance is only paying out 50% of what they should minus the deductible, right? So you need a new roof, $10,000 roof. Here's $5K minus your deductible because that co-insurance penalty. One of the things that you can do if you don't want to insure it to value, there's only a couple carriers that will do this. They can do an agreed value policy and waive co-insurance. Not many companies do that, but you can insure it for less than the replacement cost. You don't have to insure it to value. You're paying a little bit more per 100 of insured value, but you can still insure it for less. Okay, so that's co-insurance. Replacement cost, actual cash value. So replacement cost, think of it this way. What does it cost to replace whatever it is I'm insuring? So again, easy numbers. That building is insured for $100,000. I have replacement cost. If it burns to the ground, I'm getting $100,000 to rebuild that particular building. If it's actual cash value, that's replacement cost minus depreciation. So $10,000 roof, it's 40 years old. Depreciation is 80%. So I'm only getting $2,000 because it's been depreciated 80%. That's an actual cash value policy. You'll see actual cash value policies, unfortunately, too many times because the person doesn't understand what they're buying. They'll just quickly need something. Hey, I just need this on this property. It's vacant. Just put something on there. So typically, when you buy a vacant property, it's probably going to be basic form and actual cash value. Then they get a tenant in there. They don't realize, ooh, I could now potentially be eligible for a replacement cost policy. They don't think about it. Thing burns to the ground. They get replacement cost minus depreciation. And generally, minimum depreciation's going to be 40%, usually at minimum.
Yeah. I think that's you mentioned switching coverages. People who live in a house have homeowners, and then they go and they rent their property, and they forget to switch it from homeowners to a rental landlord policy. Can you explain the differences, like the issues that causes?
Yeah, the main issue is you have no coverage.
Exactly.
So that was an important one. They generally are not forgiving on that one. I've had it wasn't one of my clients, an agency owner, a friend of mine who's up in Michigan, had this happen where a client just didn't tell them that they started renting out their big house. It was like a $600,000 house, and the tenant burned it to the ground. And you know how much the insurance paid out? Nothing.
Zero.
At all. Zero. And it probably wouldn't have cost much of a difference at all. Because when you go from a single rental or single homeowners policy to a single landlord policy, you're not changing a ton. You have a little bit more risk because the tenant is in there, but you're taking off all of that personal property coverage that you had before, which is generally 60% of the insured value. So a lot of times the cost difference is not that much. It's just a matter of, hey, agent buddy, can you change my policy? But they didn't. And so that is one of the key things, is making sure that the occupancy, that the carrier understands the risk that they're insuring. Too often I see people feel like they're going to play this game with insurance. Ooh, I just won't tell them. I'll kind of sneak one by them. Well, that's great when you're paying the premium that you're sneaking one by them. But then when you actually need the coverage, you're not going to sneak anything by them. That's when, oh yeah, we're not paying the claim. Sorry. We'll refund your money because we weren't covering what we thought we were covering. So here's whatever, $1,000 back, but you don't have your house anymore.
Yeah, I feel like car insurance is probably the biggest where people have teenagers and they're like, oh, this teenager doesn't drive a car. We won't tell the insurance company.
Yeah, exactly.
Question for you, on short-term rentals. I believe, I'm not an expert on short-term rentals because I don't have any myself, but I believe like Airbnb and stuff, they have their own insurance you could purchase from them. But what kind of insurance should a short-term rental person be looking at for their properties?
Yeah, so it's very similar to a standard landlord policy from a coverage perspective, but mainly it's letting the carrier know who the occupant is, because not every carrier that will do a long-term rental will do a short-term rental. So, for example, Travelers, they do on the personal line side, single duplexes, quads, fine, and they can do some short-term rentals, but you have to let them know. And so they have an option on there. You put an endorsement for, it's like a room sharing endorsement. I can't remember the exact terminology, but it's basically adding some additional premium so that the exclusion that is typically on the policy no longer applies. So you're basically buying that coverage back to say, okay, short-term rental is now a covered cause should something bad happen. And so it's not necessarily different from a coverage perspective. It's just usually there's an exclusion come claim time if you short-term rental your property that would not no longer be applicable should you buy the coverage.
Gotcha. And one other topic I want you to get into is how can an investor like vet and find a good insurance broker to work with? Because it seems like insurance agents are much like real estate agents. The majority of them don't return your phone calls, and and a lot of them are not like up to speed on things. So, like, what's some
Yeah.
questions investors can use to vet their insurance people?
Yeah, great question. Yeah, so I think it's similar for sure when you're trying to find a good realtor to work for. If you're an investor, you want a realtor that knows the real investor segment, right? You don't want a realtor that is used to showing these beautiful properties on the front of Lookout, on the front of Signal. They don't want to spend the time writing up all these offers that are 20% below the asking price, 30% below the asking price. They think you're insane for doing that sort of thing. It's very similar working with an agent that works with other real estate investors. So Bigger Pockets is one that we've gotten a lot of traction from my agency because we've been active on there and connected with a lot. And so you can definitely go to Bigger Pockets and try to find insurance agents that specialize in the investor segment in your market. And when I say in your market, because every market's a little bit different, and you want an agent that knows your specific area for sure, right? If you called me and said, "Hey Keith, I'm buying a property down in Key West. You put coverage on it for me," I'm like, I'm not your guy. We don't do coastal. We definitely don't do Florida. I'd refer you to one of my buddies that specializes in that market. We try to stay in our lane with what we know well, and that's real estate investors in the Southeast region, with the exception of coastal. I'm not a coastal guy. I don't mess with Florida, and stick to our niche. One thing that I think is cool about the investor space, especially in Chattanooga, is just the willingness to share resources with each other. I think most people have that abundance mindset of, hey, we're not competition. We help each other out. We all win. And so just asking your investor buddies, hey, who are you using for your coverage? Have they done well? Have you been through a claim with them? Just asking those questions. If you have a client that has a similar, or a friend that has a similar portfolio as you, well, ask him who he's using. Have you had a good experience? Have you not had a good experience? One thing I would say, don't go online and get 1-800 whatever and spend 15 seconds finding coverage. If you can buy it yourself without talking to somebody, you probably don't have a good setup. So I'm going to use some names. Don't buy a policy from Geico. Just don't do it. You deserve better than that. Don't buy one from Progressive. You deserve better than that. Don't do it.
Yeah, I think it's the insurance industry kind of pivoted from service to selling on price,
Oh,
and
100%.
customers are trained now that it's price, 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 and they don't
Yep.
recognize the service component is a huge part of getting things done when you need it when something does go wrong.
Yeah,
So
absolutely. And think about it. Uh, when something bad happens, do you want an 800 number where nobody cares about you, or do you want the guy that you see at every investor thing? You host investor stuff, you own investment property, and you write insurance for investment properties, so you know how to write investment properties.
right.
That's somebody that they can hold accountable should something happen, right?
And
Um,
you're also there to kind of go to bat for them too, like
yeah,
to try to explain on your behalf on their behalf, to help them out.
totally.
Whereas if there's
Yeah,
calling their number,
yep. And come claim time, that matters too, right? So if you call my office and you say, "Hey, Keith, this tree limb just fell on our roof. Should I file a claim?" We can have a discussion about it, and we don't have to initiate a claim. If you were with Geico, you called 1-800 Geico and said, "Hey, should I file a claim? Here's what happened." You've already initiated the claim. They're sending somebody out. You've got a claim on your record just because you called in and something happened. You have no choice. You don't have an advisor who's working independently for you they're working for the carrier first. You're second.
Yeah, I think that's a really key point you just mentioned. And knowing, like, if you call the insurance, work with the insurance company directly, and you call them in and ask, "Hey, I had this situation, shall I file a claim?" The insurance hears, "We have a claim,"
Yep.
and there's no discussion about it.
Yep.
So,
Yeah, we try to get our clients because with the policies that we sell, of course, there's an 800 number for the carrier. We try to tell our clients, hey, don't call the carrier to file the claim. Call us. Let's have a discussion about it. Let's make sure A, that it's going to be a covered claim, and two, that's one that you probably should file before we even submit it to the carrier.
another question just popped in my head with the insurance industry tightening up, guidelines getting tighter. I know a lot of investors wait till the last minute before closing to go get their insurance. Like, realistically, when should investors start getting their insurance sorted out when they get a property under contract?
Yeah, great question. We we do deal with that, and the downside is if you call me the day of the closing, the day before the closing, I only have some options that I know I can quote that fast and get it issued that fast. Which it may not be the best carrier option. It's just the one that I can get quoted and issued in the timeline you need. So because you didn't give me time to do my full due diligence, I'm not going to be able to give you the best setup that we have. So I like a week if I can. If it's a single location, a day or two. If it's a portfolio, the more time, the better, because it's going to take if it's a portfolio of 30 locations, I want to be able to pull the loss history for all those locations. If you've had multiple policies with multiple carriers, I want to be able to pull all of that loss information for the last 5 if I can, for all of those locations, so that I can make you look really good to the insurance company, so that you get the best coverage at the price that makes sense from the carrier perspective. So if you don't give me much time, I can't do my best work.
So that's about all I could think of off the top of my head. Do you have any other advice or just words of wisdom when it comes to insurance for real estate investors?
Yeah, the biggest thing I think we touched on here at the end is working with an advisor who knows the real estate investor space. There's a lot of insurance agents out there. I mean, I think we're unfortunately sometimes like realtors, where there's so many of them,
Yeah.
and only some of them actually make money and do it full time. But there's so many of us. So do due diligence. Talk to them ahead of time. Do they know the lingo? When you say, hey, I'm a flip and fix guy. If that person doesn't know what that means, or I'm a buy and hold, I do the Burr method, that kind of thing. If that doesn't make sense to the insurance guy you're talking to, you probably didn't call the right guy. And so work with an investor or an insurance agent that knows the real estate investor space, so they can get you set up correctly. Because not every agency is the same. Certain agencies have certain carrier contracts that are geared towards real estate investors. Others don't. You call me for long haul trucking, I have maybe one contract where I can insure an 18-wheeler. That I don't mess with that. I'm sending that to my buddy down the road. That's all he does. And so just like when you're selecting a realtor, pick one that knows real estate investing.
One question just popped in my head. You mentioned trucking, which led me to auto.
Yep.
If an investor has, say, a pickup truck,
Mm-hmm.
when should they, insure it as a commercial truck versus a personal truck? Like, where's the line cross
Yep.
on that?
Yep. So there's a couple different lines in there, right? The definite immediate. If you have an employee and you put them in that truck, you better have that on a commercial policy. You don't, and they wreck your vehicle. Not only the damage to the vehicle itself, but the damage they cause to a third party is not going to be covered in any capacity the moment you put an employee in there. If you put it into an entity, some personal lines carriers, right? If you have an LLC, your LLC owns it. Some personal lines carriers may let you keep that on personal lines paper, but generally you're going commercial. The kind of rule of thumb is if you're just showing up to and from the job site, uh, if you're a fix and flip guy, it's just you driving the vehicle, you own it in your personal name, you're fine.
What
But
about
if you,
investor? So, like, a lot of investors will wrap their trucks saying, like, "We buy
Mhm,
houses" or something like
mhm.
that. What about in that situation?
Yep. The best thing, ask your agent and make sure the carrier knows what you're doing. That's the best advice, is make sure the agent and the carrier knows what you're doing with that vehicle, and how it's advertised, right? So generally a wrap on there, not that big of a deal. If it just is advertising your brand, but if you're advertising your brand with your employee who's driving that vehicle, you better be on a commercial policy.
Sorry, questions just keep popping in my head, so I got
Yeah.
another one for you. One thing I recommend all investors is actually read your policy when you get it. Actually read it, but especially the exclusions. What's the most common exclusions that investors need to pay attention to?
Yeah, so you touched on one of them earlier, that the sewer and drain, the water exclusions are some of the more common ones that are in there for sure. I mean, in Tennessee, earthquake and flood always excluded on every policy unless you buy it back. And so each policy has, I mean, some that you just can't get coverage for. Nuclear disaster, war, you're not getting coverage for that. So expect that exclusion in every policy. But some of the more unique ones that, okay, it's on the policy, but I can buy that coverage back. So theft on a vacant property is always going to be excluded unless you buy it back. And so just depending on the type of property you have, some of them have those basic exclusions that you can get coverage for. You just have to pay additional premium for it.
And then just real quickly, can you cover the difference between a vacant policy and a builder's risk policy and when to use each one?
Yep. So builder's risk, you're always, if you're doing ground up construction from nothing, you're 90% of the time going to do a builder's risk. There are some carriers that will let you do a homeowner's policy with a endorsement to cover the course of construction. And then if it's an existing property that you're doing renovations on, typically once you're getting into non-cosmetic type repairs, you're going to have to go builder's risk. So if you're getting into, hey, I'm moving load-bearing walls, I'm adding an addition, you're going builder's risk. It really comes down, it varies a little bit depending on the scope and scale of the work. But again, if you're working with an agent that knows where that line is, he'll know which particular product to put you in. Because sometimes you can do both. Sometimes I could put you on a vacant policy, but you may also be eligible for a builder's risk. And sometimes a builder's risk, in some cases, could be broader coverage than if I did a vacant policy. So sometimes you want a builder's risk policy, even if it's maybe a little bit more expensive, it may be broader coverage. So it just depends on the situation.
And can you cover the timelines like a builder's risk? You have to start construction within X number of days usually, and then otherwise you need a vacant policy. And then when should you transfer the builder's risk to landlord and all that? So timelines.
Yeah. Yep, great question. So the moment you got that COI and you got a tenant getting ready to go in there, put it on a landlord policy. You do not want a tenant in there on a builder's risk policy. It's definitely understanding the occupant and what that particular policy is designed for. Builder's risk designed for the course of construction phase. Landlord policy designed for when there's a tenant in there. And so make sure those line up. And a lot of it just keeping your agent apprised of your timeline so that they have it set up ahead of time. Now, there are some carriers that, if you got a large portfolio of, let's say, 20 plus, 100 plus properties, and you're a fix and hold guy, there are some of these carriers that have a specialty product to where once a month you just report what locations you've added or removed from your policy, and they'll cover whether it's a vacant course of construction or long-term hold. And then all you got to do is report once a month, and you have that coverage. And so for the bigger investors, there's some more custom products that are available that your smaller investors may not have. And so you can sometimes get a better product for your vacant stage or your builder's risk stage because of your volume.
Gotcha.
And again, that's going back to, are you working with a specialist or just your standard agent that covers, the coffee shop and covers the renter's policy and not really a specialist. There was a question that just came in asking about a named peril policy.
Yes.
That's a great question. We see this, a lot of confusion in this space as well. So we touched on replacement cost versus actual cash value. Um, those are, if a claim is covered, how is it going to pay? Named peril versus basic peril or special form, those are what is covered, right? So typically a named peril, also known as a basic form policy, is only going to cover the specific things that are listed on the policy. So it lists fire loss, covered, wind, covered, uh, a car driving through the side of the garage. It doesn't list that. Oh, you don't have coverage for it then. And so I don't recommend a named policy unless you have no choice. What you want is special form, and that basically is an open peril policy, meaning it's not going to list what's covered, it's only going to list what isn't covered. So instead of seeing fire, it's going to say nuclear disaster, not covered, flood, not covered, war, not covered. So if it's not on that list of not covered, it is covered, and that's what you want. Now, a lot of times on a vacant property or a property that's just not in good shape, you may have no choice but a named peril policy. But avoid it if you can.
Another question: what's some things investors can do to make sure they're getting the most discounts or favorability on our policies?
Yep. So if you're on the personal line side, that's where you're going to see the credit being a big factor. So uh, just ask your agent, hey, how did I look? Was did I get a really good rate? Did my credit pull well? Because we don't know the exact credit score, but we have a insurance score that we see, which is a big factor. That is your credit, and so we can tell, ooh, that rate's really high because their insurance score is terrible. And so that to me is question one. But then also, some carriers offer discounts if you have your home and auto with that same company. Some that will even do a life discount if you have your insurance with that same company. On the commercial side, um, there's what's called credit and debits. Most, not a lot of agents give this secret away, but like I mentioned on the commercial side, um, coverage uh, pricing can be negotiable. And so ask your agent, hey, was I eligible for any sort of credit? What sort of credit did the underwriter give me? A 10% credit. Now, I'll tell you, don't ask for a 40% credit. It's not happening in the investor space right now.
Yeah.
Maybe you can get 10% on the commercial side, maybe if you're lucky. That's about the most that we're seeing. Most of the time, they're not giving anything on that side. But if you're an investor and you have employees and you have a workers' comp policy, if you have a commercial auto policy, some carriers do offer those multi-line discounts on the commercial side. That is available. The biggest though is the roof age. If you have a new roof, let your agent know you have a new roof, and your pricing probably will improve.
So just want to give let's take two different examples here. So let's say we have the small investor that just bought a rental property. So would you recommend their setup being basically get renter's insurance, get the policy on the house, and have an umbrella on top? Would that be basically sort of the ideal structure for that small person?
Yeah, if I'm a solo investor and I just have one rental property, yeah, I would get a. You're probably not. You don't want to go to a commercial property, or
Right.
excuse me, commercial policy for one location. Um, Generally, you're going to have that in personal lines paper. Include that with the same carrier that you have your home, your personal residence, and your auto, and then do an umbrella. If you own that in an LLC, uh, you may have to go to commercial, but try to avoid that if you can. So that'd be a simple way to do it for sure.
What if you own multiple LLCs? You have to have a different policy for each one, or can you put multiple LLCs on one policy?
Yeah, if as long as you have the controlling interest in all of those LLCs, you can put it on a single policy. So we've done that. I mean, we have some that have 10, 15 LLCs um, on a single policy.
Okay. Looks like we had another question come in. How can you prove the age of a roof if the prior owner who got the new roof didn't get paperwork on it?
That one's tough. A lot of times, the carrier may be willing to do an inspection. If you can get a roofer out there to say, "Ooh, this thing looks like it was only 10 years old," anything you can do to try to justify. But if you really don't know, they may just by default put, "Hey, this thing's 20 years old." Um, so if you can get a roofer to sign off on this is younger, that will help.
What about if you're buying a house and then the previous owner doesn't really know the age of the house or the age of the roof?
Age of the roof.
Yeah. So like, how do you figure that out?
Yeah, that one's you're probably going to get stuck with this thing's estimated to be over
Just
15
worst
years.
case.
Yeah.
Yeah.
Yep. Yep.
Gotcha.
And then the carrier's probably just going to offer actual cash value on it. So
Gotcha.
there's no discounts. You don't get replacement cost coverage, that type of thing. And so come claim time, really when you're actual cash value, you don't really know what coverage you have until the claim on actual cash value, because the adjuster who's out there is going to go, and adjusters, I've talked to them, they hate actual cash value policies because there's no specific like, okay, this thing is definitely only worth $4,000 or it's definitely only worth $6,000. They think it's worth X amount, and so that's what they say.
Gotcha.
So ACV, if you can avoid it at all costs.
All right. Well, I think I've taken up over an hour of your time now, so I'll let you get on. But tell people how they can find you.
Yeah, so I'm pretty easy to find. If you Google search just my name, Keith Rocha, you can find me on our website, which is valorbrokers.com, Keith at valorbrokers.com. You can text us at 423-362-4166. You can find me on Facebook, Instagram, kind of wherever. Not hard to find. LinkedIn.
All right. And this video will be posted in the Facebook group. If you guys watch this later, have any questions, just post your question in there, and then I'll tag Keith to come answer it for you. So I really appreciate having you on, Keith. This is a topic I wanted to cover because I feel like a lot of real estate investors don't understand what's going on and isn't really budgeting for the fact that insurance is going to go up. So their cash flows are going to be affected by that. So I appreciate you coming on today. And yeah, we'll look forward to talking to you later.
Sounds good. Well, I appreciate having me on. It's been a lot of fun.
All right. Thanks.
All right. Take care.